Good afternoon, esteemed participants. On the screen with me, a very learned faculty, authority by knowledge, authority by post, Vishal Padole, Deputy General Manager, Market and Intermediaries, Regulation and Supervision Department. Friends, we all are reading in the newspapers and television that retail participation in equity market has been rising quite a lot. And economy-wise speaking, since due to Corona, the fixed deposit interest rates had gone down. And since the inflation is so much rising nowadays, so one may find it very uneconomical to keep his funds invested in the banking and other such channels, which are the traditional channels. So in those contexts, and because in Corona, I think people had a lot of time to spare for these activities. So many of them have started and are continuing with the activities more as investors, to my understanding, and sizable also as traders in derivative instruments. And the retail investor or trader, even though he may be big, he is not going to be getting so much good treatment from the brokers, which the institutions and big organizations may be getting. So in this context, our members are also coming up with many issues, and our committee has received over a passage of time the issues faced by chartered accountants in their own cases as investors and traders, because you must be knowing we as a council have passed a resolution that chartered accountants in shares and securities transactions, even in derivatives, even if they trade, that will not be considered as business activity for the purpose of continuation of the certificate of practice. So with this increased avenue, we receive many issues in the committee also from chartered accountants and in respect of their clients also. And we cannot have a better faculty than the SEBI DGM himself, for the reason that to our understanding, if there are disputes, for example, the one does not get proper service from the broker, one gets deficient service from the broker, one gets no service from the broker, one finds some misuses of the practices by the broker, and one finds some differential policies which may be questionable on the part of the broker. So investors and traders may think of SEBI only probably, and there also I will request Vishalji to throw some more light whether there are any other remedial provisions are there under some other platforms. But to our understanding, SEBI is the main forum and probably only forum where such disputes can be taken for disciplinary, regulatory, and maybe for compensatory aspects. So since the topic is very wide and the complexity is also quite good, and we have limited time, so I do not want to come between the speaker and you, but it is a formal necessity. So I'll request Shalini, the secretary of our committee, formally introduce the learned speaker, and then learned speaker will commence his talks with us. I am sure that question answer session will be quite active in this case. Thank you very much. Shalini, please.
Thank you, sir. So I'll introduce today's speaker with you. Mr. Vishal holds a postgraduate degree in management studies from University of Mumbai, and he is also pursuing his CFA Level 3 examination. He has more than 18 years of experience in SEBI and has worked in various departments of SEBI, such as surveillance, market regulation, enforcement department, and market intermediary and regulation department. Mr. Vishal has wide experience in the area of developing regulatory policy framework for trading, clearing, and settlement in equity and equity derivatives markets, and supervision of market infrastructure institutions. He has extensive experience in putting in place regulatory framework for the market surveillance on equity and equity derivatives, including ad hoc market-wide risk management framework, etc. Some of these specific areas of his work include review of equity derivative market, securities lending and borrowing mechanism, margin trading, and block deal window mechanism, etc. He has also worked as the member faculty in NISM, which is the education initiative of SEBI. wherein he has involved in capacity building in the area of technical analysis, derivative trading, and market surveillance measures. He is currently leading the inspection team for regulatory audit and inspection of stockbrokers, clearing members, and depository participants. So, over to you, sir, for your session.
Yeah, thank you very much, Shalini, for this introduction. Very good afternoon to all of you. So we will begin our session. So what we will be discussing today is mainly about the issues which investor or any trader who trades in the equity or derivative market, what are the issues they face, and what kinds of complaints SEBI has been receiving over the years, and what is the regulatory mechanism in place to take care of those complaints, and also what are the prerequisite in terms of or the responsibility of investors or traders when they put their hard-earned money in this market. So we will take one by one, and we will complete our presentation session, and at the end of the session we will take questions. Some of the questions we have already received, so we will use the question as well. And anyone during the presentation, if they have any questions, they can note down and throw those questions at the end of the session. So this is generally this is the flow of this entire session. So we will talk about the issues investors have faced, and to understand the issue in much more detail and get more clarity as to what has happened or what has been happening in the market, we will take one case study which is recently where SEBI has taken some action, and what has happened in that case we will have a look at it, so that we will have more clarity on in terms of the concept or the problems which we study. Then we look at the ways to approach SEBI or exchange in terms of any complaint or in terms of any difficulties as a trader or as an investor which you face, and what are the regulatory mechanism in place to ensure that the complaints are resolved in very judicious way, so that there would be a win-win situation, and the investors who have suffered because of the issues from the brokers or from any other intermediary, as basically there is justice done to them. So there is a proper regulatory mechanism in place. We will discuss that, and at the end we will also see what are the investor awareness initiatives which SEBI has taken to ensure that they will not fall prey to the sort of investment advice or the malpractices which have been going on in the market by any market intermediary, whether it is broker or portfolio management service or anyone. So before starting the presentation or the entire thing, so the first of all, whenever you are coming in this market, whenever you are coming as an investor, whenever you are coming as a trader, so the understanding of the product in which you are dealing is the prerequisite for you to be a more successful trader or more successful investor. So if you are dealing in equity markets, so what are the norms of the investments? What is the risk you are running if you trade in equity? So everyone should well versed with the kind of risk you are dealing with when you trade in these instruments. So whether it is equity, whether it is if you are not well versed with the investments in equity, then you can go through a mutual fund route. Then what are the nuances of the mutual fund? What are the expectations of returns when you invest in the mutual fund? What would be the expectation of returns in case of equity? So if you are investing in mutual funds and not in equity, so in mutual funds, it is an indirect way of taking exposure of equity. So the expectation should be a moderate than directly you're investing in equity. So these are the things which you should know. So what is the ETF product? It is exchange traded funds. So how ETFs are different from the plain vanilla mutual funds or plain vanilla investments in equity? What is the risk inherent in the exchange traded funds? Derivative instruments, futures and options. So they are inherently risky instruments, leveraged product. So as and when you trade in these instruments, so before trading, the prerequisite is that you should understand the nuances of the investments in these products and the inherent risk in this product. So if I were to tell you that, if you are trading in derivative instruments, so inherently it is a leveraged product. So if you are investing 100 rupees, so many times because of the leverage nature of product, you could get a very handsome return in futures and options. But those returns on a consistent basis, it is difficult to earn. And so there would be risk. So one day you make profit, another you make loss. So you have to consider the element of risk involved when you trade in derivative instruments. So the understanding of the product in which you are investing, suppose for example, if you are putting your money in IPO, now what is what is the business of the company, or whether the valuation which has been there, or which has offered by the company, whether it is justifiable based on the business model, based on the fixed asset it has. So all those things becomes very vital, because if you're investing in IPO, probably you would have a longer term perspective. And when you're investing in longer term perspective, you should get your homework done. Your homework should be ready in terms of the kind of returns you're expecting from the product, or the valuations are pretty high or pretty low compared to peer group. If there is no peer group, then what is the balance sheet of the firm which you want to raise funds to the market is telling you about its future. So all those things are very important. So basically, before starting, you need to get your homework done. You need to be ready with the how much you are willing to lose in the market if things go against you. So that is the first prerequisite when you trade or invest in the market. Another things about the investment is that if you are want to trade and if you are an active trader, then so there are two things which are very important when it comes to trading. The first one is selection of the broker. So what kind of broker you are selecting?
Make the PPT full screen.
Yeah. Yes. So when you are typically trading, or if you are an active trader rather than investor, so investor is one who holds and hold it for longer term. So there is not much of a buying and selling element when you take an investment decisions. But if you are a trader, if you your job is basically buying and selling for the short term or for the intermediate term, then the selection of the brokers and it's become very important in this case. So there are two models available in our market as of now. So you have a stockbrokers who are also depository participants. So stockbrokers plus DP. For instance, if you take example of discount brokerage houses, for example, Zerodha, Upstocks, 5paisa.com, all those are stockbrokers who also have a depository business. So what they can offer you is stockbroking plus DP business together. So you would have a trading account with them as well as Demat account with them. Okay, so this is one set of model, and you would have bank account with your banker, and you link that bank account with your trading account. So this is basically one set of model. Another set of model which is prevalent in this market is 3-in-1 account, which is basically trading plus Demat plus bank account. So in this category, you would find most of the institutional players, or the banks which are there. For instance, ICAI Bank, SDFC banks, IDFC, Kotak Mahindra banks. All these banks have their subsidiaries as a broking business, and they also have the banks have also become depository participants. So they can offer you a more vibrant model where the trading account, Demat account, and bank account will be held with the one single entity, and those entities are institutions. So there is a professionalism in the way in which they do business. So there are less likelihood of doing some malpractices. What we have observed is that there are less complaints from these guys, from these institutional players, rather than the one who is coming from the family-owned business or someone who is very traditional broker. So there is a difference. So we have to see which path we have to choose in terms of. So the 3-in-1 account will charge you a little more higher brokerage, but there would be a safety, there would be professionalism in the business way in which they do a business. So the differences are there. We have to select our broker based on what we want with our investment or with our trading. For instance, one way is that you could have two different sets of account. For example, if you want something to be in the investment nature, which will be holding period for a longer term, then you can select account with one set of broker. And then if you are trading on a daily basis or on a weekly basis, then you can select that with a separate broker. That is also possible. So that will segregate your trading activity and investment activity, and you can keep tab on the things which are happening in terms of returns which you are generating, risk which you want to take. So that is also that is what many people do. So that's one way of looking at it. So in terms of requirement, this is what. So ultimately, when you deal in this market, so three things are important: your trading account, your demat account, and your bank account. Okay, so you have to treat your trading account and demat account equivalent to your bank account. They are not different from the bank account. The precautions and the caution which we take while dealing with our bank account, same amount of precaution and dealing we have to take when it comes to trading and demat account. So there is not much of awareness when it comes to trading and demat account, and people don't treat them equivalent to bank account, because when you trade, your bank accounts are linked to the broker. So in all possibility, there would be a possibility of misuse of funds which are lying in your account, which you have given it to the brokers, or the securities which are lying in your demat account. So there is a possibility of misuse of those securities by the brokers. So you have to treat them equivalent to the bank account. That is a prerequisite when it comes to trading in this market. So you have to give that much importance to the trading account and demat account. Many people share their trading account login ID and credentials, or demat account login ID credentials with the brokers, and then so that is the beginning of the problem. So the problem starts only when you rely too much on the brokers. So brokers, all the stock brokers or trading members, whatever you call it, so they're, from the perspective of SEBI, they are only trade execution experts. So their job is only to execute a trade on behalf of the clients. So client should ultimately have a control on his trading demat and bank account. If you are giving your controls, your control to the broker, or control of your bank account, trading account, and demat account to the brokers, that will be beginning of the problems. That would start the you are inviting the problems in when it comes to trade. Yeah. So now coming down to the issues which we face, which we have witnessed in the market, which investors or trader faces. So there are certain issues which are related to transactions, and there are certain issues which are related to non-transaction related issues. So transaction related issues, the biggest issue which we face, which occupies 80 to 90% of our redress mechanism today, is unauthorized trades. Now, unauthorized trades is if I were to clarify it in simple language, that it is a trade which client doesn't know, but it is the trade which is executed on behalf of the client by the broker. So client is not fully aware, or the trader is not fully aware about the trade which has taken place in his account. So it is not the trade is not authorized by the client. Now there are two scenarios which emerges in this case. The first scenario is that so the client is not completely aware about the trade which has taken place in the account. Broker has manipulated the clients. So there are many clients who are not very active, so they invest, and once a while, say once in a year or once in 6 months, they just look at their accounts, and so rest of the time they are inactive. And there are certain brokers who take advantage of this scenario, and they trade on behalf of their clients. So they basically use the client's PAN number and client's login ID and all those things to execute trade which they want to execute. Okay, so this is one transaction that is so it is a fictitious trades where the client is not aware, where the intention of client is bona fide, but there has been completely misused by the stockbrokers. So this is one aspect of it. But there is one more aspect of it which is very important nowadays, is that client aware about the trade which is taking place in the account, but there is a passive decision making or passive involvement from the client. So client are not fully aware about what the trade broker is executing. Broker execute the trades on behalf of their clients, and then they inform the client that this is the trade I have executed on your account. So many times what happens is broker promises a certain amount of returns to the client that आप इसमें पैसा डाल दो, you invest in these options or derivatives or equity shares, the money will be double, or you get 10%, 20% returns in a month-on-month basis, and let me manage your accounts. So that is that is another set of things. And the second set of things is where we find lots of problems happens. So everything until things are in a proper order, until unless clients are getting return from the brokers, everything is fine. There are losses, moment there are problems between client and broker, it comes, and then we see a floods of complaints between them, and there will be disputes. So whenever you are authorizing your broker to trade on your behalf, so it is called a portfolio management service. So portfolio management service, as far as SEBI regulations are concerned, it is applicable only when the client has a trading size of more than 50 lakhs rupees. So someone who is HNI in a nature, or someone who is not a retail investor for that purpose, so it is applicable for them. So for that, you have to have separate agreement with the broker. Now your stockbroker has to have a certified portfolio management from SEBI. He has to be a portfolio manager, certified portfolio manager from SEBI, and there is a separate agreement between the client and the portfolio manager and a broker, that this portfolio manager, who is also a broker, is going to manage the funds of the clients, and he will take investment decisions and everything and inform the client. So if that agreement is not in place, today 70 to 80% complaint which we get of unauthorized trades is basically the misuse of portfolio management services. Either the brokers are not registered as a portfolio managers and they are providing these services, and then when things go wrong, we get a complaint, and we have to get ourselves and basically try and resolve the complaint. So if you are one of them who wants to use the services of broker in terms of investment tips, or where to put money, where not to put money, then we have to ensure that those brokers are certified portfolio managers, and the value of transactions which we are dealing into, it has to be more than 50 lakhs rupees. It cannot be less than 50 lakhs. Then if it is less than 50 lakhs, then those services are not something which SEBI has permitted to do for the brokers. So we will see more of it in our example, in our case study, how in a recent case, how it has been misused by the brokers. So we'll see that. So that is the first problem which we have witnessed. Another problem which we witness is the closing of or squaring of the position without the consent of the client. So here there are two things. It can happen in a derivative instruments. I'm sure all of you aware what is a derivative instruments. So basically there are products which are available on the, so you have a stocks which are available for trading in the market, and on those stocks there are derivative instruments. There are financial derivative instruments where one can take a view of the market. So you would have futures and you would have options. So options gives you more liberty in terms of which strike price, which instrument to choose, which instrument not to choose. So, and it is more leveraged than the futures. So this is financial derivatives. So when you trade in these instruments, they have a specific lifespan. So it is called expiry. So every derivative instrument has certain expiry. It can be a weekly expiry. It can be monthly expiry. So when you trade in the derivatives, you have to pay a specific margin, and if the margins are not sufficient, then your broker would have a right to square off your position without even consulting a client, because the premises of this market is risk management. So whenever you're taking any position in the market, whether it is in a cash or whether it is in derivatives, or you're buying any product which is available in the market, you have to put minimum margin before the initiation of the trade. And if that margin is not given in full as per the requirement of regulatory norms, then broker has a whole right to square off your position, whether it is a profit making position, whether it is loss making positions. So this fact, many of the clients doesn't know this fact, and so we could get complaint that my position was in profit and broker has squared off this position. So either they are not fully aware of what is happening, or broker have not them educated about the transaction, or there has not been any to and fro communication from the broker. Even the equity market, this can happen. For instance, if you are buying a Reliance share, so Reliance, suppose it is quoting at 2,000 rupees today, for instance. So if you want to buy one Reliance share, there is a facility that you need not to pay entire amount. You can pay minimum, say minimum margin, say basically 25% of this amount. So if you are paying, so it could be somewhere around 500 rupees, for example. So 500 rupees minimum you have to pay in the when you initiate the trade, and rest of the money will be funded by your broker. So this, in such kind of trades, brokers will have a right to square off your position if you don't pay the remaining amount of the money. So there is a timeline which is given as per the regulatory norms. So within T plus 5 days, you have to provide the entire money to the broker. T is a transaction day when the trade. So at the time of transaction, minimum 500 you can pay to take exposure in the Reliance, and the remaining amount you have to pay to the brokers before T plus 5 days, within next 5 days. So if you don't do that, or if you fail to do that, probably you don't remember or busy into other stuffs, then a stockbroker has a right to square off your position, whether the position is profitable or not. So in such cases, what happens is the client doesn't aware that there are these conditions, or broker do not educate their clients that there is a possibility of squaring off a position. Don't pay the money if you don't pay the full transaction value. So in such cases, we get complaints. The issues investor faces, that the profitable position, so the position was in profit, and between the position was cut by the broker, and the stock went up. So there is a potential losses. Opportunity has been lost. So all those things happens because of the unawareness, or we don't know fully what we are getting into. So that is the second biggest issue which we face. A third problem is misappropriation of funds and securities. Now what happens is that as a client, so there is a broker. Suppose if I take example of Zerodha. So Zerodha broker has thousands of accounts, probably lakhs of accounts, and they would have a dedicated bank account where the clients put their money. So when you transfer fund to Zerodha for the purpose of buying and selling any shares, or for the purpose of taking delivery or if you're trading in options or futures, so when you transfer funds, the funds goes into a different account of Zerodha, which is properly nomenclature as a client accounts, client bank accounts. But those funds are lying with the broker. Now broker would have a fiduciary responsibility to hold the funds on behalf of the clients. But many times what happens, if there is no professionalism, or if they don't follow proper practices, there would be possibility that out of 100 clients who have given money, there would be 20-30% of the clients who are not very active. They don't look their accounts on a daily basis or on a weekly basis. They don't check what is happening. Sometime they would have invested in some mutual funds, or they could have bought some stocks, and their funds would be lying with the broker only in his account. So what broker will do, there will be a lot of inactive clients, and the funds will be lying with them. So that fund, there is a possibility of misappropriation of that funds. So what broker will do is that they cannot remove the funds from that account, but they can take a bank guarantee. The bank guarantee will be issued, or there would be overdraft facility from on behalf of that funds, and that money can be deployed elsewhere. So it can be deployed either by giving exposure to other clients who are more active, from where they can earn more brokerages, or it could have altogether gone into real estate, or some other investments, like we have seen in case of Carvey. We have seen many examples, especially daily based brokers. We have we have seen that lots of funds have gone into real estate investments, or it has gone to fund the builders, or there would be affiliated entities of the stockbrokers who would be investing in real estate assets, or somewhere else. So these are the possibilities of going wrong. So funds which are lying with the brokers are prone to misuse by the brokers. So one has to be careful in terms of. So if you are not active trader, then you should not put more money. So you should always see how much fund you have given to the broker, and whether you have used those funds for the purpose of buying and selling. If you're not using the funds, it is better to take it back into your own account. Similar to fund, there is also possibility of misuse of the securities. So securities which you give. So for instance, whenever you trade, if you don't want to part the funds with the broker, you can place the securities or the stocks which you already have in your portfolio to the broker, and on the basis of those valuation of those securities, broker will provide you some exposure to buy some another stock in the market. Suppose you have Infosys into your portfolio, you can give Infosys, transfer the Infosys securities to your broker, and that's called collateral. So on the basis of that collateral, he will allow you to take some exposure, and on the basis of that, you can buy Reliance or some other shares. So the stocks which have given you which you have given as a collateral, that is lying with the stockbroker in his pool account. So over a period of time, what happens? The valuation grows up, and the pool account values goes substantially higher. So in such cases, what broker will do is that typically they will see clients which are not active, or who trades but not trades frequently. So their security is also prone to misuse. So so when you do agreement with the broker, what are the norms you have signed with the brokers? So we'll come to all those points, but everything ultimately emanates from your trading account / demat account and your bank account. So you have to have control. If you have control on these three things, then the possibility of misuse or possibility of things going wrong will be very limited. Precise point. Then another issue which we face often is a non-execution of the orders. So there would be a lot of technological issues which we are facing nowadays. For instance, you want to buy something, or you have already bought some shares, or you are intraday player and you bought some shares. You generally buy some share in the morning and sell some share in the evening, but there is a technological outrage, and you are not able to access your trading account. So because of that, there would be an opportunity loss to the investors. So what are the regulatory norms for that? So we have, so there is a business continuity requirements. So we have put in place the business continuity requirement for the stockbrokers and depository participants. So whatever loss which could occur because of that, so we have, so brokers are liable to offset those losses through a stock exchange mechanism. So this is another risk which we face. So you have taken a position and there is a technology outrage, and your profitable position turns basically loss-making position. You are unable to execute the sell order. You want to exit, but you are unable to do that. So those sorts of issues also we faces. So in such cases, we sort of we get the complaints from investors. And which we generally face is non-receivable. If you have done the transactions on the exchange platform as per regulatory norms, you should get your money back by T plus 2 days. Okay, so T plus 2 days is a settlement mechanism. If you trade on T day, then settlement has to take place by T plus 2, and by the end of the T plus 2, you should get money. Or max to max early morning and T plus 3 days, you should get the money. So many times it happens there is a delay in getting the payment from the brokers. So there are different reasons why there is a delay in the payment. So many times there are issues from the client. Many times there are issues from the broker also. So whenever you are trading, or when you're taking position or investing and selling some shares, you have to please ensure that you get the funds within these timelines. If you don't get funds within these timelines, you have to be alert and raise your complaint appropriately to the exchange or to SEBI. So we will see what are the ways you can raise the complaint. But the point is that whenever you trade or whenever you make investments, you have to be alert in terms of whether your shares are delivered to the in the market, or transaction is completed or not, and if yes, then whether you've received your money which you've sold it. So if not, then you have to quickly call up your broker or send email to him or visit his office physically and check what are the issues, why you have not got the payment, so all those things you have to be, so one needs to be alert in terms of receiving money or receiving securities in their account. This is also one of the area which we encounter the problems. Then non-receipt of dividend is also one of the issue. So this is typically not from the broker's side. So this is basically if you have invested somewhere in the past and you have been receiving dividend, and this time you have not received the dividends, then this has to do with the your demat account. Your demat account has to be updated. Many times what happens typically is that we keep on changing our bank accounts and we keep on changing our addresses from one city to another city, and that the earlier bank account is closed, but that has not been updated in our demat account, or it has not been updated through depository. Then in such cases, since the underlying bank account is not active, you don't tend to receive the dividend. So it is our responsibility to ensure that a prudent investor or prudent trader, we have to ensure that our accounts have been updated. So you need to ensure that the account which has been given to depository, whenever there is a change in the bank, if you change the bank, if you have closed your earlier accounts, you have to get it updated. So many times we find that the accounts are not updated, hence the dividend goes back, or sometimes our our addresses change, so dividend intimations goes to earlier addresses, and that has not been updated in the demat account. So ultimately the dividend has not been received by the investors. So this is another issue we face, and many complaints also received because of that. So in certain cases, we directly write to companies or we write to the share and transfer agents. So share and transfer agent is one who's been appointed by the companies to handle the corporate intermediary. SEBI has authorized there are certain authorized RTA who work for the companies, and we get it done from them, issues, and try to see where the problem is, why the dividend has not been received, and what are the issues. So this is one of the thing. Another is excess brokerage charge. Now this broking business is very competitive, and many times we get complaint about excess brokerage charge by the broking firms. So it has, since it's a commercial agreement between the broker and the clients, so as a regulatory mechanism we have very limited say in this. So whenever you are signing an agreement with the broker, you signing the KYC form, or you're signing when you open an account with the broker, what is the minimum brokerage is charging from you? One has to have a clarity in terms of whether brokerage is chargeable on the basis of the transaction value or on the basis of the trade. So all the discount brokerage houses, so-called Zerodha, Upstocks and 5%.com. So these brokers, they charge brokerage on the basis of trade. So if you take a one trade, so brokerage will be charged on that trade. Say, for example, if you're trading in options, option market, so 20 rupees is a brokerage which is charged if you want a single trade. So if you buy an option contract, so for one that trade, 20 rupees is charged. If you sell that contract, another 20 rupees is charged. So this is the typical zero discount brokerage model works. So you have to aware that what is the broker offering you in terms of the brokerage he's charging, whether it is on transaction value, whether it is on the trade number of trades. So that clarity is required from the client's perspective. But in such cases, from the regulatory point of view, there is very limited scope for us to intervene in this case. Connectivity system related problems we have discussed. So there are regulatory framework in place to ensure that there is a business continuity plan. So we have advised the stock exchange as well as brokers to have their DR sites separate from their main sites. So if anything goes wrong in their main server, they could immediately start this system up and going immediately from their DR sites. So seamless connectivity issues. So all that is a system audit requirements from the brokers, and that has been yearly. We do system audit of the brokers, and to see that there is a proper continuity planning in terms of giving flawless services to their clients. So that is a part, but still we kept on receiving the complaints in this regard also, and we try and see there is a minimum opportunity loss to the clients because of the connectivity of system related issues. So that is one area. Then account opening, closing related issues are there. Account is not opening, has not opened because of the the time has taken, broker is taking time to open the account or taking time to close the account. So these are more technical issues. It's not very important from the point of view of understanding, but there are these issues which we face. Then there's improper service. So mainly, if you ask me, the issues which are very prominent in terms of the from the investor point of view is unauthorized trades or the transaction related issues. It can be unauthorized trades, it can be a squaring of the positions, misappropriation, non-execution of orders. So these are some of the important areas where there could be a potential losses to the investors. So now what we'll do is that we'll try to see and understand from the point of view of case study and see what has went wrong in this particular case and where the SEBI has taken action. So whatever we have seen so far, we will look at from the point of view of this particular case. Now, this is Aditya Birla Money. He is a stockbroker, and recently SEBI has levied a penalty. So close to 1 crore rupees penalty is levied on this broker because there are multiple violations which has been observed in this case. And this case is also emanated on the basis of a normal complaint from investor. So investor complaints do have a lot of weightage when it comes to regulatory setup, and we do pay a lot of attention to investor complaints. So this is one of the classic case which is emanated from the complaint. Now, what has happened in this case is that one by one we will take up the issues. So the first one which we have also seen is unauthorized trading and portfolio management services. Now, this broker is not registered as a portfolio management, not registered to offer portfolio management services to the clients. Despite that, he was offering some services to the clients which were in the nature of portfolio management, and there are instances of the unauthorized trading by these brokers. So there were around 84 clients, okay, and all these 84 clients, on behalf of these 84 clients, 184 trades were executed. So we have examined the order placements and trade confirmation from this broker on behalf of these clients. So what we have witnessed is that there were 84 clients and around 184 trades which are executed by this broker. Now, so what has happened is that in all these examples, the clients were passively involved in decision-making process, meaning that they don't know, while they were aware that trades are being executed in their account, but they were not aware the risk element of the trades and what has been happening. So complete control of the trades is with the broker, and the client's money was only used for the purpose of taking positions in this market. So stockbroker in this case was executed trades on clients' accounts, and he later used to inform the client that this is the trade I have executed. Now, after the execution of trades, you're informing the client that itself is a problematic as far as regulatory mindset is concerned. Okay. So what this broker was doing is managing the trading account of the clients. Now, what do you mean by managing the accounts? So that clients have given complete control to the broker in terms of their login credentials, and everything is given to the broker. And so those were essentially a sort of a PMS services, portfolio management services, without entering into any PMS agreement with those clients. So the clients were not aware that what they are doing with the broker is actually a portfolio management service, and there are separate regulatory norms for the portfolio management services. Okay, and it is the responsibility of a broker to inform the client that this is in the nature of portfolio management services, and so there are different rules, regulatory rules applicable for that. So that everything was basically was not done, and they were not complied with. So broker was managing the trading accounts of the clients. He was executing trades on behalf of the clients and informing the clients later on that trades were executed and so much is money they were made, so much of losses they were made. So this is actually a classic case where client doesn't know what's happening. They only know they're, if I were to say, they were basically the puppets who doesn't know what's happening. So somebody is basically running the show behind them, and that broker would have promised them that you will get certain percentage of fixed or assured return at the end of the month or probably at the end of the year, and false promises have been made to these clients. And the clients were basically, when we categorize these clients, what we found that they are retail in nature, so their transaction value is basically less than 2 lakhs rupees. So such were the involvement of the client. So they were their trading size or their what do you call the involvement in terms of the monetary value was somewhere around 2 lakhs rupees. So they would be a retail, so they are not well versed with they're not well informed as far as market dynamics are concerned, and broker was not giving them full information about where the money has been invested, which company the money has been invested. And also what we have observed is that there was no trade confirmation. Many instances a trade confirmation was not given to client. So when you trade in the market, so there is a facility where you get a trade confirmation. So when you do a trade, so when you do a single trade, so you get a trade confirmation from the stock exchanges, okay, and when you get also trade confirmation from depositories. So that will ensure that the trade is confirmed and investor is aware that this trade is executed on their behalf. So in this case, the no trade confirmation was gone to the client, and the client were not aware. Broker used to inform him probably orally that they have executed trades, but there is a separate trade confirmation which happens directly from the stock exchange and depository participants. So that facility is available. We'll look at this facility in subsequent slides, but as of now we need to understand that there is something called trade confirmation directly come from the exchange, and that has not happened in this case. So that is also a sort of violation as far as broker is concerned. So a stockbroker executed the positions buying and selling of the stocks at his own discretion. That is what we have found. So what SEBI has found is that the trades were executed. So stocks were bought and sold at own discretion of the brokers. And most of the stocks which broker has, whether trades are executed, so there were losses, and the losses were carried forwarded in the positions of loss. So the loss-making positions were carried forwarded in this case, and broker basically is assured to the client that this loss-making position will turn profitable because he is in touch with the company and company is going to announce something, so the price is going to go up. He knows that, so all sorts of things. So that doesn't happen in the market. All the best companies, they never get in touch with the brokers. So there are also regulatory norms for the listed companies to deal with the portfolio managers or the investment advisors or the research analyst. So there are separate guidelines applicable to them. So they cannot simply just call the research analyst and tell them that the company is going to make some announcement and therefore it could impact the price. So whenever there is a disclosure from the company which is going to affect the prices in the market, so there are some disclosure norms which are applicable for the listed companies. So they have to announce first of all to the exchange platform that this is what whatever development has taken place. Suppose Reliance is going to get some so there is some breakthrough news in the Reliance in terms of the gas. They have find some resources, and that has probably trigger more supply of the gas. They could extract some more gas, so which probably could impact the prices. So any news of company which will probably impact the prices, that news first of all has to be disseminated to the stock exchange. So there has to be a symmetry of information to all market participants. So whenever there is a symmetry of information for the market participants, then post that probably company could call the research analyst and portfolio managers and disclose to them that this is what they have found, and because of that projected revenue could grow in this way and that way. All those can happen, but before that, it is a responsibility of a listed company to inform to the a wider forum, and that wider forum is stock exchange platform. So dissemination of information is very critical, and there are different norms. So a stockbroker, if any broker is telling you that he's in touch with the company, and that is something which is what he's telling is wrong, and that is not how this market works. So we have to be careful if broker is giving you such kind of information. The second problem which we observe in this case is misleading clients by understating the losses and overstating the profit. So typical modus operandi is that the client should not say that they are suffering losses. So many times the broker, what they will do is they will make some money to the client. They will give a payout that this is a profit on your account. So initially what they will tell you is that they will ask you to pay, put 1 lakh rupees in their account, and initially they will give you some money, in some returns, 10%, 12% returns. Then they will ask you to put more and more money so that you will get more returns. So to lure the investors, they will give some profit initially. And this profit is basically nothing. It's not a profit. It is just payout made from some other investments money, or some other investment which broker have made it in the other segment of the market. So actually positions were losses, but they were understated, and some profit were shown to investors. So it is a fictitious or overstated profits which are not genuine in nature, which we found. And stockbroker has concealed basically material facts and gave false information to its client that the position were that the positions were profitable, when actually they are not profitable. When we saw the books of accounts, there were no profits. All these losses which investors are making, basically what this broker used to do is that he used to trade in the options, and in options, whatever money he is getting in options, he used to pass it down to some of the loss making clients, so that the client should not raise any complaint, or they should keep quiet. So what used to happen is that when you trade in options, I don't know how much your understanding of the options, but I assume that you have fairly good understanding of the options. So when you sell the option, what you get is a premium value. And so if I were to give you an example, so if you can see the screen, so this is a option chain of a Nifty. So you see here, this is a Nifty, and these are the strike prices of the Nifty. So Nifty is currently trading at 17,500. And if you look here, this is option chain. So there are different option strike prices available for the purpose of taking position. Now the current value is 17,500. So if you go to 17,000 level, so these are the strikes. So what happens is when you buy and sell these strike prices in the derivative market, so this is the premium value. So 140 rupees is the premium value to trade 17,500 strike. Okay. And this is a call which is on the bullish side, and this is put which is on the bearish side. So if you're bearish in the market, you will buy the put option. If you're bullish in the market, you will buy a call option. So if you're buying a call option, it will cost 148 of this strike. If you buy a put option, it will cost 138 rupees as per the current latest price available. But on the contrary, if you sell the option, so if you're selling the call option, you will get 140 rupees. So 140 into 50. 50 is a strike price for the. So if you're 50 is a lot size. If you are buying and selling a Nifty, single lot is 50 basically. So you need to multiply 148 into 50. So 148 into 50 is whatever amount comes, that much amount you have to pay to take position in the these option prices. So as a seller, if you are selling these options, you will receive this money. So basically, if you see this, so 50 as a lot size into 150. Okay. So this much money you are going to receive as a option seller. An option seller is the one who take more risk, because his view is that price will not go above this level, and that's why he's selling this option. And option has a limited time span So there is a time value in it. So what happens if nothing changes, and with each passing of the day, or each the way options are approaching the expiry, the value keep on reducing and ultimately it becomes zero. So when it becomes zero, the option seller makes money. The option seller pocket entire premium value. So what will happen is that next day, if Nifty trades at 17,500, this option price will naturally fall, because the time value, there is a time value loss. So one day will loss, the option price will fall. So each day there will be a loss of time value, and at the end of the life of the option, this price will become zero. And the option seller want to benefit from that, from that change in the option premium. So what this broker has done in our example, is that he has sold the lot of option contracts which are far away from the current value. So for instance, if you take this case, so if you want to sell, the safe way to sell is that the options which are very far from the current value. The current value is 17,500. So if you sell 17,000 strikes, 17,050 strikes, so all this premium value are probably away from the current price. If I were to say, so if you sell the strike prices which are very much away from the current value, say 18,400, 18,350. So all these strikes, so it is trading at 1 second. Yeah. So this is 18,000 strike is trading at 12 rupees. So if you sell all these options, this becomes zero very fast. If market doesn't turn in your favor, if market doesn't go up, and if it remains at this level only and spend time here at 17,500, 17,600, 700 levels, then all these options all these strikes which are at 18,000, 17,900, they will lose the value because market has not reached close to their levels. So this option becomes zero, and the option seller will make money, and option buyer will lose all this money. So what this broker has done, that he has used the funds from the client to take exposure in the option premium and earn the option premium. And how much ever money he is going to earn, he has earned from the option premium, he used to give it to some of his client, that okay, this is a profit on your position. But in turn, it's not a profitable, because it was not the risk profile of the client was not suitable to take position in the options. Okay, so the losses which clients were making, some of the losses were offsetted by selling the option contract, and selling the options are inherently a risky position. So broker has executed a risky trades for the clients who were not very risk takers, who are risk averse client based on their profile. That itself is something which is very problematic. So if you happen to see such things in the market, you should get an alert that this is not something which I want to do, which is preferable for a broker, because position which I have taken, or which my broker has taken on my behalf, is not something which doesn't go with the risk profile, doesn't go with my own risk profile. So you have to assess your own risk. Are you willing to take how much risk you're willing to take? So if you are a risk averse trader, then the option selling is not for you, because it has element. Because if market goes against your position, you can make unlimited losses in this case. Hence, if you are risk averse, then the position which you've taken in the market is not something which goes with your risk profile. So you have to see constantly what are the positions your broker has taken. If you are given your account for trading, if your broker is trading on your behalf, whether it is PMS or something, then you need to see what position the broker has taken. That has to go well with your risk appetite. Then we are also witness in this case delay in. So what his broker used to do is he used to fund his clients. Now, when they fund their clients, they take on those funding amount. So remember, we have seen the example of Reliance. So what has happened in the Reliance? You have paid 500 rupees to the broker. So Reliance is trading at 2,000, for example. The remaining amount is funded by the broker. Now, what brokers will do? They will charge you some interest for this position which you're carrying on. So T day position was taken, T plus 5, you have to settle the entire amount. So during the intervening time, broker will charge you some interest. Now this thing, so this arrangement has to be clearly specified to the client. The client consent has to be taken that broker will charge. So the position is chargeable. It is interest. The interest will be chargeable on that position. So in our example, the consent was not taken. The client was not at all aware that the broker can charge interest from them, and the interest amount was humongous. It was 24% per annum. So roughly 2% a month interest the broker has been he has charged from these clients, when the client is not at all aware, and there was no specific consent from the client. If client gave consent, then from the SEBI perspective, we cannot do anything, because the client himself has agreed that he is willing to pay 2% interest per month to the broker if if he takes such positions, takes such leverage positions. But in this case, since consent was not given, the client were not at all aware, we found it as a violation, and we took action against the broker. Then another issue which we often face, and which we have seen in this case also, non-settlement of inactive clients. Now, whether you are active or inactive client, as per the regulatory requirements, your broker has to settle all the dues, or whether it is share, whether it is holdings, or whether it is funds. So everything has to be settled either on a monthly basis or on a quarterly basis, as per the preference given by the clients. Suppose you have given a preference to a client that monthly settlement, and at the end of the month, broker has to return all the funds which is taken from you and all the securities which is taken from you, and there should be no obligation whatsoever from the broker or from the client. So everything needs to be settled at the end of the month if the monthly settlement was given, whether you are active client or whether inactive client. That is a requirement from the regulatory side. Meaning, if I were to explain you, so if you have taken position, if you have bought Infosys shares at say 1,500 or something, and you have 5,000 rupees in your account, 5k account, okay, so you bought 2 shares, so 3,000 rupees is used, and 2,000 rupees is lying in your account as of now. So at the end of the month, so this 2,000 has to go back to your bank account from the broker's bank account. So this is broker's bank account. From the broker bank account, it has to go to your bank account at the end of the month. That is what we mean by settlement. So end of the month, there should be zero obligation from the broker to you and from you to broker. And the shares has to go to your, if the shares, any shares which you have placed to broker, which you have given to broker for the purpose of collaterals, that also has to go back to your demat account. So that is what we mean by monthly settlement. So monthly settlement will ensure that the broker will not misuse the funds and securities which are lying with the client account. But in this case, what has happened is that there were 56 inactive clients. Now, inactive clients means that they are not traded once in last 90 days. So the clients who have not traded for a quarter or something. So broker has to settle whether it is active or inactive clients. So there were some clients who probably would have bought some shares in the beginning of the year, and they just kept quiet ki haan, shares are there lying in their account, which are not settled fully. So the securities worth 26 lakhs rupees of these inactive clients were not settled by the brokers. And there was another 7 clients who had something like 37 lakhs of rupees. So in all, around 63 to 64 lakhs worth of securities were not settled by this broker. Now, what they do typically is that they don't settle this account and they don't pass it on the securities to the client. So what they do is that they can place the securities somewhere with the bank, or with they give it to the clearing corporation or the exchange, and then they take a fresh position on the basis of these securities. Now, what is the problem with the regulator is that what we don't want to happen is that suppose there is a 1 lakh of rupees security which has been lying with the broker, and he has given this 1 lakh of securities to a stock exchange to take further exposure in some other stocks. Now these 1 lakh of securities belong to some 5 clients who are not active. They know that, okay, client securities are lying with the broker, no problem. I know the broker. I go to his office every day and I know people over there. So need not to worry. So what went wrong in this case is that now what broker has done is that he has given this 1 lakh worth of securities to the clearing corporation or stock exchange and taken fresh exposure. So stock exchange will give him exposure of 75,000 rupees, for example, in this case. Okay, 75K they will give. And this 75K will be in turn invested in the market for buying shares or taking position in F&O or something. Now, if any loss occurs on this fresh position which a client has taken, which a broker has taken. So if there are losses in these accounts, so suppose sudden movement has happened, crash in the market or these accounts. So clearing corporation is not going to sit on the losses. They will recover the losses. Now the losses will be recovered from these underlying collateral, and this underlying collateral is belong to all these clients. So knowingly or unknowingly, these clients have taken exposure to these positions and they have suffered the losses without even they know that they are into trade or their securities have been used by the brokers to take exposure in some other stocks. Okay, so this is a potential problem, and then these security people will come and complain that there are losses brokers have. So what will happen is that a stock exchange will liquidate all these positions and recover their losses. So when they liquidate position, they sell. They would require to sell these securities, and these securities were placed with them. They have right to sell, so they have sold the shares. Now what will happen is that client will come and say that this is a broker has taken a trade without my consent, and there is a square of my positions were sold without informing me. So all these things happen, and that is where problem comes. So we don't want client to face the situations. Therefore, there are settlement requirements, quarterly and monthly settlement requirements. But certain inactive clients, many times we came across a client who don't really bother to see their monthly statement from the broker and to see that whether the broker has given their money back, given the securities back or not. Okay. So if you are monitoring your accounts in a regular basis, then probably this problem won't come. If you're not monitoring, if you're inactive, then there is a possibility of misuse or non-settlement of your broker, and it can go haywire. In case of Karvi, if I can tell you that crores of rupees were used, clients worth of securities were used for taking exposure in real estate assets. Okay, and when real estate markets start crashing, or probably returns, during the lockdown or before that, when there was a crash in real estate prices or prices have not increased the way they wanted it to increase, then there are problems. The brokers started losing money on the investment, or the funds which are used by the clients, they came to the broker and saying that we want our money back. So broker do not have that securities in his account, and funds were raised. All those problems occur. So one has to be very attentive to the fact that how much ever is given to the broker has to be settled at the end of the month or quarter as per your preference. So it is your responsibility as a trader or as an investor to see at the end of the month the settlement has taken place or not from the broker side. Okay, just because you can see in your trading account this much fund is lying, that doesn't mean that it is settled. It is prone to misuse by the brokers. So you have to take it back to your bank account. Suppose you made a profit of, say, some lakhs of rupees profit you made. So you can see the profit in your trading account, but that profit is still notional unless and until you convert the profit into money flowing from your trading account to your bank account. So unless and until it comes to your bank account, it is not a profit. Okay, so potentially things can go wrong. We never know. So we have to ensure that it doesn't happen. So in this case, we have seen that is happening. Another thing which we witness in this case is SMS alerts. So there is a SMS facility which is enabled. So whenever you buy and sell any share, the depository will alert you in terms of they will send you OTP and all those things are there. So those flags were not enabled. So clients used to never know whether what brokers were doing with their shares. Again, there are also issues of power of attorney. So we give power of attorney to the broker, and many times we give blanket power of attorney. We sign the power of attorney. Our intention is that that broker will do it genuinely in our favor. But many times, power of attorney, giving a power of attorney to the broker is that you are giving your what do you call your bank account credentials to a broker, okay, or you are giving your say your debit cards to the broker, go and use it as per your convenience. So it is equivalent to that. So power of attorney, whenever you sign a power of attorney, you ensure that you should not give a blanket power of attorney to your broker. So what are the contents of the power of attorney? What is the limit in terms of the transactions? All those things, what are the scenarios in which power of attorney will be triggered? All those things you have to ensure. So we have seen the misuse of power of attorney in this case. Then another misuse is the transferring the securities from the broker account to a from the client account to broker account. So in this case, what has happened is that what this broker has done is that around 5 to 6 lakhs of rupees he has transferred from the client demat account to his own account. So the misuse can happen that broker uses these client's funds for the purpose of his own obligations. So he has a proprietary trading desk and there are proprietary obligations, and the broker knows that there are some inactive clients, money is lying with him. He can possibly take advantage of this money and use it for the meeting his own settlement obligation. So that has happened in these instances. So that is one misuse or problem which we face day in, day out. Now, so this is what generally we have been witnessing as far as typical trading and settlement related issues from the client perspective. Now, what are the steps which you have taken? So most of the things we have discussed during the presentation only. So there is a running account settlement. So we have to see, you have to give preference for running account settlement, that every quarter or every monthly basis, as a client, it is our responsibility to see that we check whether the account has been settled, the funds lying with the broker has been come back to your own account, securities lying with the broker has come back to your account. That one has to ensure. And there's also requirement of physical records. If you are not online, the one who trades online, you prefer to go to broker office, then you ensure that there are proper records of what you are buying, what you are selling. Broker has enough of systems in place to ensure that it records all the transactions which you take place. So that is for the safety of the client. In future, any issue arises, you can always have a proof with you that this transaction has not been authorized by me. It is unauthorized transaction of the broker. So physical record. Similarly, telephone recording also is there. So we have advised brokers to maintain the telephone records of the clients where they get telephonic orders. Similarly, email authorization from the clients, internet transaction authorization. So offline, online authorization, how a client has been authorizing the traders to the brokers to initiate the trade. So one has to ensure that you have the authorization, you gave proper authorization before executing the trades. Now, coming back to the ways how we can approach the regulator or SEBI in terms of whenever we face any issue. So there is this website. So there is a something called Scores. So it is a SEBI complaint redressal system. So it is an online system or online mechanism where investors can file any sorts of complaint using this website. So one needs to first register in this website, register yourself with the website, provide your credit details like PAN card and all those things, and then you register your complaint, whether it is complaint related to broker, whether it is related to whether it is related to stock exchange, whether it is related to depository, broker, depository participants, merchant banker, mutual funds, portfolio managers. You name the institution in the market, and it will allow you to launch a complaint. Okay. So what it does is that it is an online 24/7 platform. So you can launch the complaint using online platform anytime from anywhere. Once you launch your complaint, you get an email or SMS instantly acknowledging that you are receipt of the complaint, that your complaint has been launched. Okay, and the unique number is generated. A unique complaint number is generated. Now, based on that unique complaint number, you can review the status of the complaint, what has been, whether it is resolved or not, what is the stage of your complaint. You can send the reminders or to regulator that, okay, 15 days or 20 days or what is the status of my complaint. So it is a centralized database. So we keep on receiving the complaints from various investors in this on this platform. So we have a centralized database, and every month MIS reports are generated on the basis of these complaints. To understand what is broadly going wrong in the market as far as the investors are concerned. Okay, so we take it as well as we take it as an input for the purpose of further improvement in the system. Okay, but before launching your complaint or coming to approach regulator, there are certain things which you have to keep in mind, that you have to have certain copies of the agreement with the broker, or some forms which you have filled in, account statement, contract notes. So whatever documentary evidence which you could demonstrate there, you have to keep these things ready with you before approaching a regulator. Okay. So now, once you launch the complaint, there is a grievance redressal mechanism which is available. So this is very well known and well set up framework, which is doing very well as of now. It has been there from last 15 to 20 years in the market, and we have addressed multiple complaints to this framework. So how this framework works is that, so the first layer in the framework is investor service cell. Now, every stock exchange and depositories will have an investor service cell. Okay, so the complaint which we put it in the SEBI score. So a complaint which service cell of the exchange and depositories. So it reaches there first as a first layer in the redressal mechanism. And if it doesn't resolve in the investor service cell, then the second layer in the mechanism is investor grievance redress committee. So it is called a GRC committee. So which are the complaint which are not redressed, or the aggrieved parties can approach to investor GRC committee. Again, if issues are not redressed in the GRC committee, it goes to the arbitration. And post arbitration, if there also you want to draw, if another party doesn't satisfy with the arbitration award, then there is an appellate arbitration panel who can look at the issue, relook at the whole issue, and try to resolve the issue. And after the appellate panel, there will be subsequent higher court. Maybe it is high court or Supreme Court, depending on the gravity of the case. So then it goes out of the SEBI domain. So it goes to basically judiciary systems. So this is the typical grievances framework mechanism which is in place. Now, in terms of the investor service cell, what happens is a complaint which we put it on the score platform, which goes directly to the exchange investor service cells. Now, stock exchange have to resolve this complaint as per the regulatory framework. They have to resolve these complaints within 15 days. So what they typically do is that the process is that once they realize the issue raised by investors, whether it is what is the typical issue, whether it is a payout or pay-in issue, or there is something else beyond that. So there is an analysis of the complaint, and they take up the issue with the trading member or with the broker. They call up with they take up with the broker. They call the broker, discuss with him the complaint, and try to see try to analyze what the complainant is saying, or what the investor is saying, and what the broker has to say. So analyze the response from the brokers, okay, and then discuss with the investors, and then they hold the meetings if required, teleconferencing if required for the investors and the broker, and try to resolve the complaint. Okay, and so all this have a timelines of 15 days. So exchange has to resolve 15 days and report to SEBI in the score platform that whether complaint is resolved, resolved in the process or not. And if one of the party is not aggrieved with the resolution provided in this in the investor complaint cell, then the second level to approach is grievances resolution committee, GRC committee. Okay. Now this is a little higher level than the investor service cell. Here, what happens is that since one of the it is so, the GRC committee will reopen the complaint right from the beginning, and they will analyze. They go through the records which investors have submitted till date to the exchange and to the investor service cells. They analyze the complaint. Okay, opportunity is given to both the parties to represent their case. They hear both the parties, investors as well as broker in this case, or investors, and if it is a listed company, and if it is a PMS holder, if it is a mutual fund, then mutual fund, any other market intermediary, for example. So they hear both the parties. There will be detailed discussions and the clarifications will happen. So the GRC will hold the different meetings. Okay, and after the meetings, they will come to conclusion, record their admissibility claims. So they prepare the order mentioning the outcome. So whether the claims made by the investor is acceptable, how much quantum of the trade is acceptable. So many times what happens that the investor makes a claim, say 5 lakhs rupees, but it doesn't get accepted. GRC doesn't accept the entire claim, depending on the case to case basis, because the date of the transactions, the valuations, all those things differ from the understanding of the investors and understanding of the brokers. So GRC will come to that conclusion that this is the value of the admissible claims and all that. So the cost of entire exchanges, so nothing has been charged from the investor, nor it is charged from the brokers. So it is borne by the exchange solely. So that is the beauty of this framework. Now typically what we have seen is 15 days is there. So what GRC will do is that they'll try to amicably resolve the complaint in next 15 days. Okay, so what GRC will do is they ascertain the value of the potential claims. Okay, and once the claim is established, say the complaint is of 5 lakhs rupees, and the GRC at whatever value exchange, and that investor protection fund is a huge corpus amount. So from that investor protection fund, money is blocked in favor of the investor once the GRC has come to conclusion and ascertain the value of the claim. If they ascertain the value of the claim somewhere around 5 lakh rupees, then the 50% of the value of the claim is basically blocked in favor of the investors. Okay, and once the GRC confirms that GRC resolves the complaint and gives its verdict, then within 7 days, one of the parties has to inform whether they want to go ahead with the arbitration with the next approach the next authority or not. If within 7 days they don't hear anything, then everything is settled, the complaint is closed. But if one of the parties aggrieved and they want to approach higher authority, so then they can go for arbitration. Okay, and if they have decided to go for arbitration, then 50% of the claim value or 75 lakhs rupees, whichever is lower, is basically blocked in favor of the investors. So this is an interim measure for the investors. So if you see, the entire framework is not be lost to investors at any point of time, and investors' priority or traders' priority is considered has given a highest priority as far as claim settlement is concerned. So the specific amount is already blocked. Say 50% of the claim value is already blocked, because what happens many times, the arbitration it goes to arbitration, and then from arbitration it goes to arbitration panel, and then it keeps going on. So there is a no limit up to which it can go, and the timelines also blocked. There is a considerable amount of at this stage itself. So there is some relief to the investor that at least this much amount of money is going to get at the end of the day if nothing turns in his favor. So that is the idea behind the interim measures. So if you talk more about the arbitration mechanism, now the next stage is arbitration. So this is a quasi judicial process to resolve the complaints between the stockbrokers or investors, or even between the broker to broker, between the investors and any other intermediary. So complaints which were there in the system is treated as closed because once the arbitration process is initiated, because it's a quasi judicial process. So the complaint for the matter is treated as closed. Now arbitration, since it is a quasi judicial process, the application to arbitration can be filed within 3 years of the dispute. So as per the law of limitation, within the 3 years we can file, anytime within 3 years we can file the appeal in the arbitration. Okay, but the intimation has to come within the 7 days itself after the GRC awards. If GRC has concluded the matter, then within the 7 days only you have to tell the GRC that I'm going to appeal as an investor or as a aggrieved party. They need to inform that they are going to appeal in the they want to file arbitration mechanism. So if you see so there are many complaints also we received from investor that GRC has given the award in their favor. However, they have not received money till date because of the arbitration process. Now arbitration has its own since it is a quasi judicial framework, time. Okay, so the money has got blocked. So we have often we face this issue to sort of investor money has got locked in the process. So once you adopt the complaint mechanism, you have to follow all the process and the procedure of land of the law, so to ensure that the matter is concluded. So this is basically one of the drawback of arbitration, because one has to wait for the, so if everything goes in proper fashion, then probably basically nothing can happen and the matter can be closed earliest time. But if aggrieved party doesn't file, he's just filed the intention, but actually actual application has not been filed with the arbitration, then one has to wait only for things to move. We can pursue them, but legally we cannot do anything. That's how the regulatory framework is in place. So again, in terms of arbitrators, there is a choice of selection of arbitrators. So a tremendous amount of flexibility is given to aggrieved parties to select the arbitrators. So you have a choice to select the arbitrators from the exchanges. Okay, or there is a random system generated process which will select the arbitrators for the for the particular case. Okay. So the claims valuing more than 25 lakhs, you have panel of arbitrators. So more than one arbitrator is there if the value of the claim is more than 25 lakhs in this case. So we have seen that it is a quasi judicial process. Now arbitration also, if it goes in favor of investors, then also there is for the stockbroker has to decide whether he wants to appeal to appellate arbitration panel. Okay, in case stockbroker decides to go ahead, in case one of the aggrieved party decide to go ahead, then the what happens is that so money will get blocked further. Okay, and the GRC award, is a difference between the award value, then the higher amount value will be blocked. So the differentiated amount value, suppose in case of our dispute of 5 lakh rupees, GRC has agreed 4 lakh rupees, but the arbitration panel has awarded 4.5 lakhs rupees. So the difference, 50% of the 50,000 rupees is again blocked in favor of investors. So each stage there is some comfort which is given to investors in terms of blocking the money in their favor. from the investor protection fund. So the next next level is appellate arbitration panel. So here's arbitration panel consisting of senior functionaries. So those functionaries can be retired judge or retired senior functionaries from the financial markets, from the Reserve Bank of India, and some senior people who have experience of dealing with the complex issues, dispute issues. So they are in the panel. So again, here the panel decides based on the merit of the case. They hear the parties and they decide what will be the appropriate outcome. A matter settles here. The investor gets the money, or the broker gets the money as per the award which is accorded in the arbitration process. But however, if aggrieved party for the regulatory framework, again there's certain additional funds, if at all there, it is blocked. So in the process the matter get delayed. That is a drawback of the thing. But at the same time, there is a justice which is done to the investors. So nowhere, if you see, every stage it has been considered, the framework has been laid in such a fashion that there has been considerable amount of benefits been given to investors, in each of these phases. So the next phase is basically court of law, and all of us knows it takes its own time. Then it goes out of SEBI purview. Here at least we can push the exchange and arbitration panel to sort of expedite the things, expedite the cases. If at all we are hearing the complaints from investors, if we get to know from the investor that it is taking too much of time, then we somehow try and push it and ensure that so you would see it starts from the complaint, which is a score. So this is one of the platform which is available for investor. Similar platform is also provided by NSE and BSE, which is NSE is the biggest stock exchange, and BSE is also another big stock exchange. So they have also provided another platform, but most popular people prefer to launch the complaint is this one, which is called. So it is in this platform you can just, and anybody who has a grievances, they can launch the grievances. So from this core, it goes to investor cell of the exchange, where it has to resolve within 15 days, or then if it doesn't resolve and one of the parties aggrieved, it goes to investor grievances redressal committee, GRC. GRC also has to resolve it within 15 days. So most probably what we have seen is that 80% of our cases get resolved up to GRC level, because the amount of the claim, if it is less than 25 lakhs, then it resolves very easily. And say in a month's time, you get your money back and everything is settled. But value is, and multiple parties are involved. So if there is more than one broker, okay, so then it gets more complicated, and then it goes to arbitration, appellate panel, and court also. So if there is so many times whenever there is a default from the brokers, so there is something called a clearing member. So what happens is that the structure is, you have brokers who are trading members, and these trading members operate through clearing member. So clearing member has multiple trading members under him, and then there is a client. So client 1, client 2, client 3. Trading member. So he clear the trades, clearing member. So whenever there is a problem with the clearing member, there's a default by the clearing member, it has a cascading effect on all the 3 trading members who are operating through him. Then in such cases, generally we have seen that the cases goes to arbitration, even arbitrate panel of the arbitrators, because the complications are, there are multi-layer issues are involved. Okay, so in such cases there is a considerable time it goes, considerable time lapse before we could resolve the queries, or we could resolve the complaints. So this is typically the grievances framework works as far as the capital market is concerned. In order to avoid that, so what is the best way? If you ask me what is the best way, best way is to educate ourselves. If you're an investor or a trader, the best way, certain unavoidable circumstances we cannot do away with. That is a part and parcel of life. That is part and parcel of trading. Risk is even there. But as a matter of prudent investor or prudent trader, we have to educate ourselves more in terms of what product we are trading, what is the risk element involved when you trade in those products, whether it is equity, whether it is derivative, mutual funds. So what are the expectations we have from the market? So that is the first aspect. Second aspect is that you need to know what are the practices are there to investor aware of the trades. So there are lots of information dissemination which has been made available to investors. So transaction details can be availed from the exchange directly. So you can avail the transaction details from your broker, and if your broker is not giving the transaction details, you can register your mobile number with the stock exchange. The stock exchange can directly send you messages on your mobile, and you can see your transaction statement from the stock exchange website also. So that facility is available. So you can avail the facility and get yourself aware about those things. Weekly funds and securities balance. So every broker inform their clients the weekly funds and balances. So while they are settling the transaction on a monthly and a quarterly basis, but at the end of the week they have to inform to the client that this is the amount of funds, the amount of securities lying with me. So I owe you this much of funds or this much of securities. So this is broker has to intimate or inform to the clients on a weekly basis. So as a prudent investor or trader, you have to see whether you are receiving those messages or not. If you're not receiving those messages, it should alert you. You should go and approach a broker and ask him why you're not getting this message. This is a regulatory requirement. So this is one thing. Advisory messages are there. You should not fall prey to tips that invest. So what case we have seen that in that people, so that broker has told their client that they will get assured returns because he has linked with the companies and he knows the company, they will do well and you could get more returns. So all those advisory tips should be, you should not fall prey. You have to take advisory tips only from the institutions which are registered as a portfolio management services with SEBI. Okay, so if they are registered portfolio managers, you can see what tips they are giving. Look at your own risk appetite, whether you can take that much of risk. Just because broker has asked you to buy some stock, you should not go and simply buy. You have to do your own analysis, you do your own homework, see whether you're willing to take risk. Then you are always welcome to take risk. Of course, all the investors are here to take money. So you have to, unless you trade, you're not going to make money. So making money is one part, but doing homework for that, assessing your own risk before taking those advices is ultimately important.
Sir, we have received lot of queries. Sir, if you permit, may we take them now, sir?
Yeah, I'm at the end of the slide, so we can take queries now. Fine, I'm fine with that.
Okay, sir. So I'd like
to invite. Just give me 5 minutes. I will have just give me 5 minutes.
Okay, sir.
Start. Yeah.
Friends, we are classifying the queries. So if you have some more queries, kindly send the same to the Shalini on our portal so we can further classify the queries. Uh, Vishalji, you have come back?
Hello. Yeah.
Hello. Vishal,
Shalini,
you have
can
come
we,
back? Shalini, where are you?
Sir, I'm here. Vishal sir is back.
Shalini, you write, means inform
Yeah,
the,
I'm back. Yeah, we can take the questions.
participants. If
Yes,
there
sir.
are more queries, they can be sent to your portal, so we'll further classify them.
Yes,
With
sir.
the manner in which you can inform. In the meantime, whatever queries have been received, we have tried to classify so that queries number can be reduced. Are you ready, Vishalji?
Yes, yes, yes.
You are ready, no?
Yes, yes.
Your session was very, very informative. In fact, after hearing your session, what I thought was we can keep a comprehensive refresher course, maybe of 3 to 5 days, in which we can start from ABC of the share market investments and reach to where you are today, or maybe there might be some higher level of what you have spoken today. So the questions we have classified. You mentioned business continuity requirement. Now, in this context, there are some queries that suddenly the website of the broker got hanged. Although NSC was functioning, BSC was functioning, and due to this, there were many price changes. You mentioned some compensation also. So how the trader or investor can prove this compensation or claim?
Yeah. So what typically happens is that whenever there is a technological outrages, whether it is from exchange side or whether it is from the broker side. So many times we seen it from the broker side. It happens that the brokers are not giving feeds, are not coming, or uh, it is not operational. So in such cases, if you have the one who has already taken some position, if you're a trader, if you're doing a day trading, and you stuck up in your position, you couldn't sell that position, and have a right to launch a complaint to the on SEBI website, on that score website, stating that this is a opportunity lost to you. So that there is a provisions where there are instances in the past also where the losses have been investors have been paid their dues if there are genuine cases of transaction losses because of the opportunity loss, not able to trade, not able to place the order, or not able to execute your trade which is already there. So you took a trade and you want to exit now, but you couldn't exit. You tried to sell, you are unable to sell, and after that price has fallen. So there is an opportunity loss to you. So not opportunity loss, there is a real loss to you because you could have sold it at much higher price, and now because prices have fallen, you don't know the prices, and when the thing started, when the broker terminal started operating, you saw the price was different than your target price or something. So in such cases you can launch complaint, and then it goes to investor cell. They analyze it, the outrage time and all that, and if they find genuineness in the complaint, then it gets resolved.
In the context of derivative transactions, I am required to pay some margin money upfront. Now
Yes.
that I am paying in respect of my futures and options transactions, but my broker's website is showing my total margin utilized versus how much fund I have kept. So the example says that I have kept, for example, 10 lakhs, and the margin used is 9 lakhs 50,000. But the website is not showing per script how much margin has been utilized. So if I want to reshuffle my portfolio, then I should know for which share how much margin has been kept, which the broker is not giving. The broker is appearing to be giving full margin utilized.
Yeah. So
Any NSE rule regarding this?
yeah, exchange. I mean, SEBI and exchanges both have put in place the framework where the stock or if you're trading derivatives, then each option will have a margin requirement. So each stock has a different margin requirements. So if you so if you're buying in Infosys, the margin requirement will be different than if you're buying TCS shares. So based on the requirement of the margin, broker is going to charge you, and broker has to show you what. So when you buy shares, suppose if you're using Zerodha, so Zerodha will when you do a buy transaction, it is visible in there that how much money is basically required for you to. So typically what happens, there are two things. So if you are trading on a leverage, so for example, some brokers, for instance, 5paisa.com. So what they will do is that they have provision where they will charge minimum margin. So now what exchange and SEBI has defined is a minimum margin, okay, which is value at risk margin, for example. And there are some other component of the margin. So that can be in the range of 15% to 20%, for example. Okay, so they will ask you to pay minimum 15 to 20% at least to take position, and remaining amount they will fund it to you. And when the transaction gets settled, or when you get shares in your demat account on a T plus within the T plus 5 basis, you pay the remaining amount to them. So this is the one model which is available in the market. Second model is that you pay entire amount. Supposing 10 years of Reliance, what is the rate into 10? So 23,000 you need upfront to basically buy and sell, basically buy the shares. So when you place a buy order in case of Reliance, so it will show you 23,000 if your broker is following this method. If they have a facility to give you a leverage in the cash market also, then there is option. When you open an account with the broker, there is option. So if you select this opt for this kind of framework, then minimum 15 to 20% you have to pay. That's why there is a difference in the practice. So what exchange and SEBI has specified is a minimum requirement. So minimum requirement, and so over and above that, broker can charge based on the risk profiling of the client, or if he wants to give leverage, he will charge less. But that less cannot be less than 15-20%. It can be in the range of say 25, 30, 40%, up to 100%. So depending on what model the broker has given, what model broker has adopted for the purpose of giving you exposure in the market. So nowadays, to acquire the clients, the first model is preferred by the traditional brokers like 5paisa, Motilal Oswal, and all that. This model is basically given by the discount brokerage houses like Zerodha, Upstock, and all those people will ask you to pay entire money. That's why there is a difference script to script as well as broker to broker. But if you were to know what is the minimum margin from the exchange side on the stock, you can find it out on the exchange website. So one sec, I'll just show you. If you go to NSE website, okay, and just typing here TCS, if you go here, so here you can see.
Sir, we are not able to see your screen. If you can share the different ones.
No, Shalini, we can see measures for surveillance.
No, sir, this is the slide. He's opening the NSE website.
Okay.
One second.
You can simply mention Vishalji, because we have many queries. And
okay. So in the
now I can inform, and our members are quite computer savvy, net savvy. They will do it afterwards.
Yeah. So in the exchange
what
website,
I'm understanding is that you are saying that one can find out from NSE website.
It is here. You can find out from NSE website what is the margin applicable in the stock. So it is.
But what I understood from my earlier discussion was, and practically also, that every broker has a differential margin.
Yes.
Banking brokers are keeping higher margin. So supposing one finds from the NSE website say you said Infosys NSE website, some margin is mentioned. But the broker may say, I am keeping some more margin. Then is it okay?
Yeah, that is okay, because that is based on the risk profile of the clients and the philosophy what broker is following. Some brokers will take some, because what happens if they take minimum margin and if stock falls, then they have to call for additional margin from the client, and they have to fulfill the additional
So
margin
here the
with
query is
exchange.
that the party wants script wise margin requirement, whereas broker is giving total margin utilized. Is it a allowable practice?
Yeah, that is something which is broker, between the broker and the client, because what as per regulatory requirement is concerned, we require them is that they should take this much is minimum margin they should take. Okay, beyond that, script wise he can take more.
No. The issue is, Vishal, the issue is that
60%, it is his understanding with the client, agreement with the client. So
the issue is about the information to be provided to the investor. That investor wants script-wise margin, so he is, I think, reshuffle the portfolio. For reshuffling, if he does not know how much is the script-wise margin, he cannot reshuffle. That is the issue here. So whether it is allowable,
then broker has to provide information. Yeah,
broker has to provide
information has to be provided to client, that what is the margin requirements for each of the scripts.
Okay, so it has to be.
Yeah.
Now, as far as you mentioned monitoring, and there are issues regarding monitoring, that if one is not monitoring, and after 4 or 6 months, one realizes that there is some mistake in the account. So, in the normal parlance, also, what we have understood in our other legal practices, that if there is a mistake or if there is a wrong on the part of anybody, then that wrong cannot be allowed simply by writing that you have to inform within 8 days or 15 days, thereafter I will not be responsible, something like that. So here also, for example, somebody is not monitoring. Is the first question. Connected question is, are such wrong in accounting or related aspects happening in banking kind of brokers to your experience?
Banking brokers, I mean, we don't find much problems with the brokers who have affiliations of the bank. So there are very few affiliated brokers, bank affiliated brokers. There are issues. Majority issues are coming from the non-institutional, non-professional, non-institutional brokers, actually. The family owned brokers or some other types of brokers. But the banking brokers, they are generally very professional in terms of the way they do their businesses.
So in that case also, now this 4 to 6 months, supposing one is finding out a wrong in the account. The wrong is not disputed, it appears, but 4 months have gone, and then one points out that this is a wrong entry or something like that in the account. Can it be a cause of redressal or remedy?
Yes, it can be redressed. So even if you come across after 1 year also, so wrong has been done. So there are two ways we can detect the malpractices. One is that we get a complaint from investors. We get complaint from investors that period pertains to last year, even prior last year also. So we have no, we are not saying that you should just come within 15 days or something. What we're saying is that you try and monitor on regular basis. Okay. But if you monitor after some time and you came to know that there is a problem, so you approach SEBI and the complaint will be redressed. There is no issue.
So remedy is there.
As a matter of remedy is there. As a matter of regulatory supervision, we do inspections of brokers, audit of the brokers. During audit also, if we find that something is happening, without even complaint coming from the broker, we take action against the broker. Despite that, there is no complaint.
For these audits, you are appointing chartered accountants or maintaining some panels of chartered accountants?
Yeah, for good question. For internal auditors, there are requirements for chartered accountants, I think. Okay. And system audit also, I'm not sure what is the system audit requirement. But for internal audit, there is a requirement of chartered accountant.
Now, in this case, I am operating my account with a broker, and the broker generally in the trading hours is receiving the phone on a landline. But many a times my phones are taken on mobile and answered on mobile. So, what about the recording aspect you mentioned in your speech?
Yeah. So recording sense, whenever you place an order through a phone, so there are dedicated lines which broker would have. So all those dedicated lines from wherever calls comes from all those dedicated lines, they have to keep the records of all those transactions. So
No,
whenever we
but
go for
right,
audit,
mobile
yeah,
also. That's many a times he takes on mobile and does the transaction, something like that. So mobile is cannot be a dedicated line. No?
yeah. No, if there are certain relaxation which was given during the lockdown, but mobile mode of it is like a private property, of a person who is, suppose you are dealing through some dealer, and then you're calling the dealer on his mobile and placing an order, then there is no record for such orders. So there would be potential problems in such cases, because what we want brokers to do is that there are dedicated lines, so investor has to call them dedicated lines, the conversion has to be recorded, and so that if there's a dispute in future, we can ascertain whether the order was placed by the broker himself, or investor has requested for broker to place an order. So that is the reason recording requirements are there on dedicated lines, not on the specific mobile phones of the employees of the broking
But
firm.
here I think the question is on the line that supposing broker receives on mobile and he executes a transaction, then who has to bear the
Mobile based
response?
app, you're saying?
No, mobile, the landline versus mobile. So if
Okay.
if a investor telephones on mobile, broker receives on mobile, executes the transaction. So who is to bear the response? Supposing there is a wrong, then the broker is not supposed to keep the mobile record.
Yeah. So if it is a part of the recording, is record keeping framework. So if the mobile, investors orders on a mobile, if it is a part of the record maintenance framework of the broker, then he has to maintain the records of the calls which are received on the mobile as well. Generally, we have seen there are dedicated lines and those are recorded, but mobiles, it has to be part of the record keeping framework of the broker, and that has to be communicated to the client that you can place orders even through mobile to our mobile number, and this is a dedicated mobile number where you can call. So all such numbers are also supposed to broker are supposed to keep a record of all those calls as well.
There are
It has to be part of the record keeping framework of the broker, all those mobile numbers. Then brokers are responsible if anything goes wrong.
so the answers appears to be that if he is doing on mobile broker, then broker has to maintain the mobile record.
Yes.
Isn't it?
If the correct.
There are futures and options transactions. In respect of option transactions of the nature of put, put. For purchase of the put transactions, one has not to pay any margin money, because if either the put transaction will result into zero value, or it can give me some value. But it is informed by the broker that in last few days, the put purchase transaction also attracts margin money. So the first question is it correct that put purchase transaction can also be subjected to margin money? The second question is that if I have purchased the put, I can always square it off before the expiry date. But the broker is squaring off if the put transaction becomes into inverted commas in the money. So what are the margin money requirements of put purchase transaction, and Whether the broker can force me to square off earlier because of lack of margin, even though I have time period up to expiry, and before expiry I can always square it off, and there cannot be any loss. So you,
Yeah, I got I got the things. I got the question.
you understood it?
Yeah, I got it. So there are two things, there's options. Okay, there are options on Nifty's index, and there are options on Nifty. There are options on individual stocks, for example, Reliance. Okay, now individual stocks are to be settled in a physical mode from last 2 years, 2 to 3 years. The settlement in settlement in the index is a cash settle. So because there is no underlying instrument, it is a basket of stocks. So there is no one particular stocks here. So the delivery is based on the cash here in index. So only monetary benefits are exchanged. If you have made money, if you have made profit, you will get money. If you made losses, you will suffer the losses. So cash settlement at the end of the expiry. In case of individual stocks, the expiry happens on the basis of physical delivery. So when you buy options, if you are buying a put option, first of all, the answer to the first question is, if you're buying a put option, you have to pay margin. So value of the put option is 100 rupees, for example, and the lot size is 50. So 5,000 rupees is the margin money which you have to pay. So for the option buyer, the entire amount of the premium, so this is 100 rupees is the premium. So entire amount of the premium is payable as a margin. He has to pay the margin, because this is a maximum loss the option buyer can take. If everything goes wrong, he will lose 5,000, not more than that. So therefore, entire money is taken as a margin in case of option buyer. So if you're buying a put option, whether it is index, whether it is individual stock, entire money has to be paid upfront in the beginning of the trade as a margin. That is the first. So answer to the first question. Second question, in case of index options, if options goes in the money, there is no problem because your position is profitable. Broker will allow you to continue to hold the position. But if it is an individual stock, and if the option goes in the money, your put option goes in the money, what will happen? Because there is a physical delivery. Now you need to understand what is a physical delivery. Physical delivery means at the time of the expiry, last day of the expiry, you have to deliver the share. Now, if you bought the put option, which means you have a view that market will fall. Okay, so you become effectively you become a seller. So when the option will come at the expiry, you have to deliver the shares of a Reliance. Now the quantity, depending on the lot size of Reliance, what will happen is that suppose lot size is 500 shares. So 500 shares of Reliance you have to deliver at the time of expiry. If you're now, what brokers will do is that because there is a physical delivery, they will increase this put option margin during the last week of the expiry, or they will square off your position, because then the margin goes substantially higher. It goes more than lakhs of rupees. So for 5,000 rupees margin, for example, during the expiry week, it goes up to value of 500 shares of Reliance. So Reliance share about 2,000 rupees into 500 shares. What will be the value? That much margin they will collect. Because in the money ka matlab kya hai? In the money means your position is profitable. Okay, your position is profitable, and you are willing to deliver that much of quantity shares to the buyer. That is what it means when the put option is in the money. So there is an obligation to deliver. If you buy a call option, you have obligation to take delivery. You are buying, so you are bullish on the market, and market goes up. Okay, so you bought at 50 rupees and market gone at 100 rupees, for example. So you bought a call option. Now call option mein aapka price बढ़ gaya, you got benefited. So call option means right to buy. So you have a right to buy. So that right is exercised at the time of the expiry. Now since it is a physical expiry, physical delivery, so on the expiry date you have to buy all those shares of Reliance, because your option is in the money. Now you have to buy 500 shares. So in order to buy 500 shares, you have to have that much quantity of shares in your demat account. Otherwise, you have to have equivalent amount of margin, so which is 500 into value of Reliance. Similarly, if you bought a put option and market went down, your option is in the money. Now your position is profitable. So you have to deliver the quantity. Put option buyer is ready to deliver the share because he has a short view on the market. He believes that market will fall. So when put option will benefit, 100 में लिया आपने 50 हो गया तो 50 rupees is gain. So put option means you have right to sell. So when you have right to sell means you have to have something with you to sell. Okay, since there is a physical delivery, you have to have delivery with you, physical 500 shares of Reliance in your account. If you don't have, broker will either square off your position or he will ask you to pay substantial higher margin. That margin is equivalent to 500 Reliance shares. So that is how it works. Hence the margin substantially goes up during the last week of the expiry, monthly expiry. In case of individual stocks, in case of index, it doesn't happen. This doesn't happen. Only once you have to pay margin. That's it. I hope this clarifies the doubt.
Sir, you are on mute.
There are various kinds of broking firms. The general understanding is that, without not referring to any name, that most of the non-banking broking firms, Vishalji, are many of them are trading on their own account also. So in cases like in March 20, the COVID episode happened and the markets fell very hugely. So as an investor, as a trader, I may have a belief, justifiable or not, but I have a belief that since these traders are also, these brokers are also trading on their own account, therefore in such crisis times, they themselves come in problem. And at that time, they are likely to use the funds of the clients in one or another manner. So first is that, is it possible in the kind of the structure the SEBI has put up, the NSE has put up, like in the before some decades we used to see that the brokers used to fail, but nowadays there is no report. But supposing some broker fails, can the investor suffer because of that?
So now there are frameworks are in place. So now there are two things which is happening from last couple of years. So there is a portability of the client positions in the market. So what has now happened is that earlier the exchange has obligation only till the trading member, broker. If broker fails, client का किसका कितना पैसा है, exchange was not in a position to identify that. Only when the client comes to the SEBI or exchange that, okay, I paid this much to broker and this is my money, now I want my money back. So that used to happen earlier, but now there is a portability in the framework. So each broker has to report to the exchange that how much money is taken from each of the clients. So this is a weekly reporting format. And now exchange is in a position to know a broker has 3 clients, and each of the 3 clients, how much money each of the 3 clients has given to the broker. So how much broker is having money, or how much broker is obligation towards each of them. So that's called portability. That portability has come into place from last couple of years. So that is a good development as far as a segregation of funds and securities is a concern of a stockbroker. That is the first thing. Second thing is that in the weekly reporting format, so now wherever brokers are, so brokers are required to maintain a specific bank accounts which are separate bank accounts only for the purpose of receiving funds from the clients and giving fund back to the client. So I am a broker. I have an account with ICAI Bank, HDFC Bank, and SBI, but I can only have an account with ICAI Bank named as ICAI Bank client account. So I have my accounts. I'm XYZ broker or zero the client account. So when I say zero the client account in ICICI, I have to put all my funds which I am receiving from the clients in that account. So I am not allowed to put any other fund into that account. I cannot take out anything from that account. So those segregations are come into place. This came in 2018 or late 19. It is implemented. So now there is a complete segregation. So proprietary trading, so bank account, prop trading. So there is a separate account. Client account, trading, separate account. Clearing corporation, trading, separate account. So funds, so you can only get funds from the client only in the dedicated client account. You are not allowed to take funds, clients from any other accounts. And in audit, we check that only whether the funds are coming from the client to that specific account, and whether the funds are going from the specific account, those specific nomenclature account, to the clients or not. That is what we check in audit. So these possibilities are rare now, but there are instances where what happens is that what brokers do is that certain brokers which are not institutions or not very professionally run organizations, what they do is that they take bank guarantees. Now I'm a broker, I know the bank, so I have a relationship with the bank. Years together, I have account with the bank. So what I do is I take money from the client and put in the client account only. I don't touch that money, but I take a bank guarantee or overdraft facility against the fund which are lying in the client account, and use that money for the purpose of either my own trade or put into some other businesses, allied businesses. So that kind of things also happen. So we are nowadays tackling that issue to avoid all those problems. So there is earlier it used to be rampant. Now it is 70-80%, it is not there, but there is still possibility of 10% that can happen even today's environment with the indirect clearing of the transactions, though not directly.
So you are on mute.
I fully concur with your view, because your measures must be very strict, but a delinquent person can find out always smarter and smarter ways to defeat the systems in place.
Therefore, client has to, it is more also a responsibility of the client to check at least on a monthly basis. You should not put too much money into the trading account if you are not trading.
I would only visualize that if there are some insurance companies which take out the insurance of these broking firms, then I think probably the investor and trader can be far more safer. I am sure in the times to come.
But we have a investor protection fund, and it has a very large corpus. Okay. It could be somewhere around 1,500 crore to 2,000 crores. So that takes care of the investors, sort of interest. So it is for the interest of investor education, and repayment of investors' funds with the loss of brokers. So all that is there.
So many times in Economic Times, Business Standard, we read that the market lost so many thousands capitalization in one day. So if the crisis situation happens, then whether this 1,500 or 2,000 crores,
that is true.
Anyway,
we never know how much is enough.
Not just to place a point for your consideration.
Right.
Next point is Vishalji. Many of our members, like us, we feel that we have good analysis of the economy. And if we sideline this chartist and what is called technical analysis, on fundamental basis, how the economy is likely to move, how a particular sector like oil, like IT industry, like exporting industries are likely to move. So many of our members have good reading of the economy. You mentioned that for giving the advices, one has to be registered as a portfolio advisor, right?
Yeah.
And that I think will include many services. But supposing one wants to become only an advisor, because chartered accountants by and large, their clients are approaching chartered accountants in many situations for various advisory services. Now, in today's times, advisory can be oral also, advisory can be by SMS also, and everything can be proved also.
Yeah.
So whether simpliciter advisory services can be registered or there is no provision?
Simply research advisory can be registered with SEBI as a research advisor, research analyst. So there are separate provisions for that. If anyone who's giving only advice that this stock is fundamentally good, or it's a P ratio is down, so P ratio is less now. Based on the balance sheet figures, or based on the analysis of the business. So one can advise. So that is possible. But there is separate regulatory requirement which are very relaxed in nature. It is not because they are not handling the funds. So it has nothing to do with fiduciary obligation. So it has relaxed norms so there is separate things one can get enrolled into it.
Because the query is, there are various YouTubes through their channels suggest unsolicited advices on various shares. They have large follower size. It may lead to,
Yeah, they make a disclaimer that we are not SEBI registered investment advisor, research analyst. This is my opinion. This is only opinion. You consult your advisor before trading. All the disclaimers they give actually.
Now, Vishalji, let me tell you, like we give many advices on taxation and various fronts. And even a solicitor's firm, whenever we give advices, there is always a disclosure paragraph that you are supposed to analyze the facts and the situations on your own, and you have to take the call on your own. And this advice does not mean a kind of guarantee. We give various kinds of disclosures in our opinions. So if a simplistic disclaimer is made, I think the readers, the investors are idly going to give any importance to this disclaimer.
Mm-hmm.
So is it a case that with disclaimer I can go on advising? Because if my clients have faith in me, then they will not read the disclaimer. They know that, and he can be told also that this is a formal requirement. Ultimately, he will read my recommendation only.
Yeah. No, so from SEBI perspective, we have regulations in place that you have to have, if you are giving any advisory in capital market for shares or any equity derivatives, then you have to get registered yourself as an investment advisor or research analyst. That is a requirement. However, there are many things, many people do it without getting registered. So as and when, even in CNBC, you see many recommendation comes from CNBC, but SEBI has taken action even in some of the CNBC people who have advised about the stocks, advised about the stocks, and they have taken a contrary positions. So they have advised people to buy, and they themselves have sold it on that day. So as and when we in terms of during our routine, monitoring of the market and surveillance mechanism, we take actions. We keep on taking action against people who are not registered. When it came to our notice through complaint or through our surveillance mechanism, we do take action against people who have not registered with SEBI and continue to give advice, whether it is through television or any more. Even in Ahmedabad, last month we take action in Ahmedabad. There is a broker. He was giving not broker, individual who was running the Telegram channel, and they advise people to do buy and sell, and they used to trade before that, contrary to the
if it is only like monetary penalty, like in your presentation in the initial slides you mentioned SEBI has fined something like 1 crore to Aditya Birla, something like that, right? Now my understanding is that they would have made crores and crores of rupees, so 1 crore is hardly peanuts compared to the volumes they might have handled. Now here also, if somebody has to run YouTube and he is a very popular person and he will be having lakhs of followers, and if the ultimate punishment is some lakhs or some amount, then probably he will continue running a show. That this is and secondly he can also get himself registered. No, any big requirement is there for registration, he can get himself registered. No.
Yeah. So getting registered is something which we want, because he is registered advisory. If he is registered, then we would not have any issue in terms of. So what ultimately we want is that investors should not get themselves involved with someone who is not recognized anywhere, who doesn't have any
protection of investors.
So, when you registered as a SEBI registered advisor, then there are certain due diligence for you. So for example, if you are registered and you are saying buy Reliance and you yourself are selling the Reliance on the same day, then you are not that doesn't fall under due diligence obligation. So SEBI is liable to take action against you. So that's what we don't want. All
now, that is a very fantastic point you are mentioning, because general belief is that many of these channels, their speakers come on the channel that you buy this. Before they have bought, before announcing this, they might have bought. And after
Yeah.
telling you to buy, they might be selling.
They-
So any audit is going on this aspect by the SEBI, or?
Yeah. Yeah, we actually we have been into it. Many few cases we have cracked already. Few cases we are working.
Because our understanding is that SEBI understands everything, SEBI can find out everything. But if it is a complaint-based mechanism, then complaints in India do not happen so much. If it is a
Yeah.
proactive
No, we have
approach,
surveillance surveillance mechanism is there. So we have a surveillance mechanism. So in the surveillance mechanism, I think last month we took some action in Ahmedabad where there was a Telegram channel, private Telegram channel run by a few people who have not registered, and they used to give recommendation to the clients to buy and sell, and they themselves used to take position prior to their recommendation, and they exited. So their trades have matched with the client's trades, opposite contra trades they used to take. So there we took action. We seized the property. So many things we did. So it is not only complaint, but it's online surveillance mechanism where because ultimately everything is reflected in the transaction. So when you monitor the transactions and you came across that one pan is repeatedly appearing against the few sets of pan, okay, so then it is very easy to find out कि भाई कौन है ये बंदा बार बार ये सेम पैन के अगेंस्ट आ रहा है, ये ट्रेड हो रहा है इनका, तो what is the problem? So then you dig out, you'll find out, okay, there is something which is going on, and that way. So that is the one example which I'm sharing. So these are the ways we try and crack the things which are happening in the market. Ultimately, it is reflected in a transaction.
right? But I think by now they must be taking care of seeing that the pan does not repeat and things are done in such a manner that So the
It is
next
always very
question.
difficult. No matter what you do, there is a solution or second layer of thinking. That's how. But we have to live with that. We have to keep doing our job in the best interest.
The next question is, I think there is some margin requirement changes proposed. I read out the question. Proposed margin system change from 1st March 2022 for investors. Currently, investor needs to have shares placed before trading buy sell. But from 1st March 2022, investor needs to have 50% cash margin and 50% value of shares placed before trading. This will pose a big impediment while buy sell for an investor, because no investor can plan his purchase sale in current volatile markets.
Yeah, I got the point.
Yeah, okay,
where they're coming. Yeah. Yeah. So what has happened earlier? So this 50% cash and 50% non-cash. That's how we call it. So 50% cash means you have to pay 50% of your margin. Suppose 100 rupees is a margin.
So this 50% just to this 50% for equity buying or for derivative buying? What is referring to?
Any trade you take in this market, okay. If it is a derivative trade, or whether it is equity trade. So if it is derivative trade, it has to 100% in the
no derivative. So they are as such also asking the margin. So this
no,
is
even in equity maybe 50% cash and 50% non-cash is there. So that was, I mean, it was always there. This framework is been running from 2004 onwards. But what used to happen? Stock exchange takes margin from the clients. So now this requirement was there earlier also from stock exchange to brokers. So what broker used to do is that if they are trading in behalf of their client, they used to put their own money and whatever they collected from the client to the exchange, and they used to meet this requirement of 50%. But now what SEBI has done in 2020 is that because of the lot of volatility we witnessed in 2019 and 20, what we said that you have to collect the same framework of the margin from your client as well. You cannot pass it on to, you have to take 50%. Suppose I'm a client and I'm trading. So I have to put 50% money in cash and 50% in form of collateral, then only broker should allow me to trade, otherwise no. So why this requirement is put in place is because there is we have seen 2020 a lot of Nifty has gone from 8,000 to 50,000, and then it was every day we saw there is a 300, 200 points more than Nifty. So volatility has increased. So in order to reduce the volatility framework, bring stability in the framework, we said that there has to be cash component, because problem with the collateral or the shares, what happens is that suppose you have a Reliance shares and you give Reliance share to a broker, and your broker has given Reliance share to the exchange that this is my margin, and in this margin money I am buying a Infosys share or TCS share. Now if anything happens to the if anything happens to either Reliance or TCS, or if there is a fall in the prices of Reliance and TCS, your entire position is get affected. Because if there is a 20% fall in the Infosys, for example, which is the collateral you've given, since collateral value is down, broker has to sell the position which you have taken on the basis of that collateral. So there is a cascading effect of the collateral which is kept in the market because of the change in the valuation. So whenever you give shares as a collateral, there is a cascading effect on your position which you opened up because of that collateral. Hence, there has to be some hardcore component of money which is a cash, which has no risk in terms of variation in the prices. So we told that you have to keep 50% in the cash, 50% in the collateral value, because we want a stability in terms of volatility. Only collateral in the form of shares will have a risk of falling the prices of the positions because of the underlying change in the underlying value of the collateral stock. So whenever there is a change in the value of collateral, the position which is opened up because of collateral will also change, because either you have to put money or liquidate the position which you created. If you don't have money, broker will sell the shares. A broker will sell the shares. Imagine if one broker will sell the shares, there are hundreds of brokers who start selling the shares, then there is a problem. Market will fall. The price will fall. So that cascading effect has to be stopped somewhere.
This question is on policy matter. I'll read out if you can answer. When will the foreign investment limit for mutual funds be raised?
Yeah. In the sense.
So if you are answering this, probably you may inform what is the limit presently, and is there any contemplation for raising the limit?
What I understand is that this question is if it is related to the investment by mutual funds in foreign stocks. If that is the question, then
no.
Recently we have reduced that limit.
No. Vishalji, one sec. When will the foreign investment limit for mutual funds be raised? So what I am understanding is that this is an Indian mutual fund in which how much foreign investment can come.
Okay.
I think this will have a very big impact on the market, because if foreign investment limit can be increased in mutual fund.
Mm-hmm. So I have very limited say in this because it comes from the foreign exchange limit, foreign investment limits from the government of India and RBI in financial sectors. Today it is 49. Today it is in the range of 49%, and the majority has to be held by the Indian firm. So that is a much bigger policy issue, which
so it will be government of India's foreign policy rather than
it is sectoral foreign investment policy of government of India, which is there.
Now, this is a general question. If you find it, you might have answered it probably. What are the major areas of grievances from traders?
Yeah. So traders, so there are two things we often find that about the grievances is about the losses which they face in. So in F&O traders, we in and out get complaints that they have suffered heavy losses. They have taken positions in option, and there is no counterparty. So there is a whole money, the entire money, or there is unauthorized trades. I'm not aware how this, who has created this position. I have never taken this position in whether it is derivative or cash. So two main component is about the unauthorized trades and the understanding about the their positions, their how the position is frequently turned into losses, or there was no counterparty in the trades. So this is so unauthorized trades we have discussed. We have seen that in the presentation also. We saw the example, and we discussed that there are possibilities of unauthorized trades, whether a client knows it or whether a client doesn't know it. If he doesn't know it, then it is very straightforward case. The client will get benefit from SEBI in terms of IPF. The losses will be make good. But if you know that trades are then it goes in different angle. You have to see the intention of the broker, intention of the client, and it is slightly dicey. It becomes. In terms of understanding of the market, many complaints comes that my account is gone. I mean, it's entirely vanished. I lost all my money. There was no counterparty for me. So in case of derivatives, derivatives, it is important for a person who trades derivatives to understand the market. So not all trades. This is a first consideration before trading in derivatives. Even though you are trading in Reliance derivative contracts or Infosys derivative contracts or TCS, or no matter how liquid the underlying stock is, the underlying stock liquidity has nothing to do with liquidity in options or derivatives, because derivatives, you have a different strike prices available for trading. The strike prices which are far away from the current price will not liquid. So if you take position in that, and by the time you party to trade, but when you want to exit from the position, there is no counterparty, because that contract is illiquid. There are very few buyers and sellers in that contract. So whenever you trade in derivatives, it is advisable to trade in the derivative contracts which are near the underlying price. So you should trade at the money contracts or in the money contracts, so not deep in the money contracts or deep out of the money contracts. So not all the contracts are liquid. That is what we have to take it.
To my understanding, Vishalji, hello.
Yes, sir.
To my understanding, liquidity and all these things are not the problems to be resolved by the broker. But in litigations, we do come across cases where the client tells that suddenly the website stopped functioning, and I became helpless. To my understanding, all these broking firms, including the listed companies and including banking firms, they are earning so much that if they can't keep a alternate arrangement when the website stops functioning, then I think that is where I think there is deficiency of service. That is my understanding.
Yeah, correct. You are correct in your understanding, and we also have a same understanding. If they are earning so much of brokerage, it is their first responsibility to give uninterrupted service to its investors. So it is because the any disruptions in trading or giving feeds about the prices to investors will have its own opportunity, losses, and gains to investors. So whenever such things emerges, it is the consideration is always given to investors, and we ensure that justice is done in terms of the offsetting the losses, or educating investors that the objective is to give make things in favor of investor. That is there in our
Vishalji, thank you very much for this very, very informative uh, deliberation. In fact, in you, we see the face of SEBI,
and we
and today
often
we
may
are.
so
Hello?
loss because of
Hello? Am I audible?
So you are audible. There is some connection problem with Vishal sir, I guess.
Okay, Vishalji, can you hear?
Yeah, I can hear you.
You can hear. The deliberation, the presentation by you, the answers by you were very, very informative and enlightening. In you, we see the face of SEBI as far as we are concerned. And SEBI is, I think, taking all the possible steps for the protection of the investors and traders. And I think there is good mechanism set up at the SEBI level. You also informed the grievance redressal mechanism from complaint level to I think court level. My only last question is that apart from SEBI, is there any other forum where the investor or trader can approach either simultaneously or as an alternative?
Yeah, alternative. There are mechanisms. There is you can approach the Minister of Corporate Affairs, Minister of Company Affairs, MCA. You can approach them simultaneously. You can approach Minister of Finance and Stock Exchange as well. So these are the four frameworks where investor can go simultaneously and raise their trades or any issue which they are facing.
To be very precise, I am not attributing, but in litigations, we have seen that stock exchanges are generally favoring the brokers. So investors and traders do not find so much level playing platform. SEBI is a very independent regulator. That is my observation.
Yeah, correct. But yeah, I know, right? Actually, trading members. So there's a conflict. Stock exchange is very conflicting business. So
True.
you have they are quasi regulatory organization on one hand, and on the other hand, they're members who are stock brokers. So clients' business comes to their members. So
Because
there are
the
instances when
same members give the vote for electing the NSE board, etc., BSE board, and the other forum, can it be, for example, I have received deficiency of service, and can I go to consumers forums?
yeah, you can approach consumer forum. There is no bar from someone to approach consumer forum because it's it is open to them. But I think redressal, faster redressal through you come to regulatory framework. I mean SEBI framework. That's my view. Though I have not
What
had
are the
experience of
what
going
are the
through a
case laws that
forum,
consumer
but
forum may tell
people
that go to SEBI?
Yeah, actually, they because when there is a simultaneously, quasi judicial framework is there, so they advise people to go and approach SEBI.
Because when there is specific mechanism in the form of SEBI,
Yeah,
consumer forum may
yeah,
become a generic
then,
forum.
yes, yeah, and it would take more time to redress
True.
the queries and understanding the queries and so maybe that could be the
Vishalji, thank you very much. It was a very, very enlightening session, and we look forward to your more and more participation and guidance in the securities related issues and in other manners also to the ICAI. Thank you very much. With this, I will present a formal vote of thanks to Vishalji on behalf of all the participants, my colleagues, and on behalf of ICAI and on behalf of my committee. Thank you very much, Vishalji. Thank you. Friends,
thank you, Tarunji. Thank you
we
very much for
close the
giving
proceedings
opportunity.
here. Thank you.
Yeah. Thank you.
Thank you very much, sir. Thank you. Thank you.
Thank you, sir.